Getting some stability in the rates outlook is critical for riskier assets. We have been in a period of absolute upheaval in the economy, and this has left prices unstable. It's both from the effects of stimulus as well as the effects of shocks to the economy. The pandemic, the massive changes in the sources of demand in the economy, the disruptions in supply, the war. Getting some stability in the rates outlook is critical for riskier assets. And the probability after a double-digit loss of having some positive return in the bond market hits a higher probability. So less volatile asset class that's received a large loss, 12% the year to date.
We've definitely had probably the worst drawdown in history over the last 40 to 50 years in the bond market. And really, the reason for that, of course, is the Fed has been raising rates so aggressively and communicating a rate hike path to higher rates by the end of the year, which has really moved all fixed income instruments lower. Further, the Fed hikes, the faster it hikes, there is an increasing possibility that the economy is going to slow quite quickly, and so longer-term yields will become attractive.
We ultimately do think that levels of inflation are unsustainable at current points, but it's going to take multiple years for inflation to get back down to sort of more normal levels where the Fed will be more comfortable. A key part of our strategy sort of on the equity side, as sort of we weather this near-term period of uncertainty, is to really lean into those companies and stocks that are best equipped, in our view, to deliver durable earnings. When we look at these types of companies over the long term, they do tend to exhibit higher returns with lower volatility, and most importantly, in these types of environments, a smaller beta to the downside. But I think in the short term, given the current crunch from consumers around inflation, that sticking to our more defensive approach continues to make sense until we have a bit more clarity in both the stabilization in inflation in the bond market, but also whether or not we do see a recession.
This has been a period in which public markets have adjusted much lower, and it's got to have significance through to markets where you're less visibility on price and opportunities arise.
The current macroeconomic and public market climate poses new risks and opportunities for alternative investments. U.S. private real estate has consistently distributed income over the last 20 years. In an inflationary and rising rate environment, certain real estate sectors, such as multifamily industrial, are well positioned to deliver the cash flow growth investors need to hedge against inflation. And lastly, when companies can't rely on public bond and high yield markets for their financing, private direct lending strategies become a key provider of credit financing to the market.
Our tactical return outlook for public market investments is 12 to 18 months. Unfortunately, now when we think about the outlook for the economy and financial markets, we have to truly assess the long lags that it takes for monetary policy to fully be felt in the economy. And the desire to knock inflation slower over a short period of time really can't be met. The tightening that we're seeing this year will be felt mostly in the economy, the largest effects in the coming year.